Hey folks, well, today has been a wild and exciting ride. About 11 a.m. Eastern time, all of the markets just started falling down. Gold and silver started kind of plunging and taking a nosedive. Silver dove like 10% in a straight line down. It's crazy that a market as large as gold can fall so fast like that. The S&P started falling at the same time, but maybe at a slower rate than the precious metals market. I looked at the Bitcoin chart and it started falling too. It went from 67,000 to 65,000 in less than an hour. And then even commodities like oil, it all started falling. Basically everything. You can see that even the 5 and 10-year treasuries, they started falling before equities and commodities. Not sure what happened at this time, but it certainly was a big turning point in the markets today. The Nasdaq was down over 2%. In other news, we just got a new jobs report, and what this can tell you is that you can't trust this thing. It has a history of being inaccurate, and it's pretty meaningless as far as I'm concerned. Why do I say you can't trust it? Because they revised it down nearly 1 million jobs. 2025 ends up being the lowest growth outside of a recession since 2003. We had 135 jobs added in January, but almost all of them were in healthcare or something like that. It's not like we're talking about a diverse set of jobs here. And really 135,000 jobs is really just not that many jobs for our size of economy anyways. But in this new report, we've got jobs that were created many years ago that they're basically saying, hey, they weren't actually created. What kind of madness is this? This is craziness. 2025, 1.1 million jobs basically eliminated from the report. So that works out to be 90,000 jobs per month, which is, once again, it's just not very many. 2024, I think over 800,000 jobs were eliminated. I'll say it again. Another reason that this job report stuff just isn't very meaningful is it's not telling you how many people are working multiple jobs. People that are working jobs that they're way overqualified for. You know, for instance, maybe some tech or bank financial guy just has to pay the mortgage and now he's working as a dishwasher, or maybe he's waiting tables or a bartender. Who knows? There's people out there that are working jobs that they don't want to be working. They just, they have to take these jobs, even if it pays barely minimum wage, just to put food on the table. So that's not telling you that. And also there's tons of people that just gave up. You got Gen X people in my age group I've been reading, they've basically taken forced retirement. They've been trying to get a job for a year now and they're facing ageism and they can't find a job. And then some of those guys are just working part-time. As far as the consumer goes, we have more signs the consumer is not very confident. I don't know if you've checked it out, but that last consumer confidence index, that thing was lower than during the pandemic, which is crazy. We can have a worldwide pandemic and the consumer is more confident than they are right now. But the latest news was retail sales were flat over the month. Basically, this is just telling us that people are hesitant to buy. And I've been experiencing that in my digital sales online as well. It's been very slow, except for international buyers. Real estate, the latest news, previously owned home sales are down 8%, but the price was a record high for January. Maybe that's telling you why there haven't been many houses moving. You got these all-time record prices in January, and then they're down 8%. Maybe that's telling you might want to drop the price on your house if you're interested in selling it. I personally think the housing market's just going to stagnate until something pops in the stock market. There's people already underwater. They can hang out where they're at until they lose their jobs, so hopefully that doesn't happen. But I don't think the housing market's going to be going up anytime soon, personally. The stock market's not looking good. We might be barely off of all-time highs. Sure, it hasn't went down. If you look at it in terms of real money, gold, the Dow has not fallen this fast except for 3 times really in history: the Great Financial Crisis, 1973, and the Great Depression. I'll put a chart on the screen. Right now, it takes less than 10 ounces of gold to buy the Dow. That's less than it was 10 plus years ago. So a great portion of this stock market is just inflation and the currency being devalued over the last 5 years. I think it's a bit of an illusion, if you will. Looking at the international stock market, Brazil, Japan, Mexico, Britain, all of these stock markets are on fire and they're just walloping the S&P 500 this year so far. My British tobacco stocks just keep going up. They were both up again today. My emerging markets ETF is up 10% in the last month. My Mexico ETF is up 11% over the last month. So international stocks remains to be the place to be. My prediction is the United States stock market, if you look at it over a 3-year return, QQQ is currently 27.7%. And I think before this is over with, you're going to see annualized returns of less than 10%. This idea of 15 to 20% gains a year is about to come to a halt. Why do I think this is the case? Because these valuations are simply just unsustainable. The Shiller PE is over 40 right now. This is the second highest in history. And some people will say, oh, that doesn't mean anything. But if you look at the plots of 10-year returns at this level of Shiller PE, it just doesn't look great. Little to no return. And it's not like that's the only valuation metric. It's not like things we've seen in the past. This time we have multiple signs telling us that something is wrong. I just personally think this stock market is cooked. It's overvalued. We have all sorts of flashing signs here. We have the Shiller PE. We have the Dow to gold ratio. We have silver to oil, which is a great predictor of recessions, by the way. Dow to GDP is sky high as well. I just don't see anything to propel this stock market higher. I personally am not going to start buying back into my total market ETFs or any of my growth ETFs until this thing just comes down. Maybe the Shiller at a PE of 30 would be better. That's probably where I'll start buying in again. I don't know. I guess I'll just have to see how it goes. I personally am continuing to focus on international stocks, dividends, and just building up cash. That cash is probably getting inflated away to some extent, but if I earn 3% on it or 3+% in treasuries or my money market, that's better than throwing it into the S&P 500 and watching it go down. I'm in my 40s and I can afford to miss out on a little bit of gains to take some risk off the table while this thing calms down, and I think that's where we're headed. At the same time, this is not financial advice. It's just simply what I'm doing, given the knowledge that I have. I've been in the market since 2005, with just total market ETFs. But as an active investor since 2018, I've been through some, major corrections at this point. And I just feel like this time does, in fact, feel different. And I'm ready to play it a little safer here. Well, you guys take care and stay globally diversified. Stay on your toes out there, and I wish you all the best in the markets.